Welcome back to the Deep Dive. Today we are cracking open a subject that, well, a lot of people know they should deal with, but often end up delaying: life insurance. And the main character in this whole story, the one factor that really dictates everything else, it's your age.
It really is.
I mean, our sources make it so clear that when it comes to life insurance premiums, time is definitely money. And every single year you put it off, you're paying this heavy, measurable financial penalty.
A completely avoidable penalty, too.
Exactly. So our mission today is to dive into the actuarial data, the economic principles, and really give you a clear quantitative look at the math behind your rate and, why waiting just 1 year can be a huge mistake.
That's the key right there. The penalty is quantifiable. I mean, life insurance is fundamentally a promise. It's a contract where you pay a premium.
In exchange for a death benefit.
Right. And the cost is all based on these actuarial tables that assign a likelihood of death. So the older you are when you buy the policy, the closer you are to that statistical point, and, well, the more expensive it's going to be.
I think people get that intellectually, that the cost goes up. But I don't think they realize it's not just a little bump. It's almost an exponential curve, especially once you get into your 40s and 50s.
Yeah.
So how do insurance companies even start to build that risk profile? What's the main tool?
They rely on decades of mortality data. And it's all encapsulated in those actuarial tables you mentioned.
Okay.
These are really sophisticated tools used to estimate life expectancy and mortality rates across huge specific groups of people. And based on that data, every single applicant gets assigned to what's called a risk class.
And that's the foundation for the premium.
That's the foundation for everything.
So age is clearly the #1 factor. But our sources lay out this, a truly comprehensive list of other variables that go into that classification. What are they looking at besides just your date of birth?
Oh, it's exhaustive. They look at, of course, your gender. Women statistically live longer than men, so...
So they generally get a lower rate, all else being equal.
Exactly. But then the real deep dive starts. They look at your overall health, your weight, blood pressure, any pre-existing conditions, and then, crucially, your family's medical history.
Okay, and then lifestyle comes into play.
Lifestyle is massive. Smoking status is it can dramatically increase your premium. We're talking sometimes tripling the cost compared to a non-smoker.
Wow.
And finally, they look at your job. Is it dangerous? And any risky hobbies. Things like skydiving, hang gliding, that kind of stuff.
Right, things that signal an increased risk of accidental death.
And all that pushes you into a higher cost category.
So it's like a scoring system for your own mortality. If you're a perfect score, you land in the best class, maybe it's called Preferred Plus or Elite, and you pay the lowest premiums.
That's it. And if you fall into what they call substandard rates, maybe because of a health issue or that skydiving hobby, that's where you pay the most.
But, you can't change your age, but some of those other things are controllable.
Precisely. And that's the hopeful part. If you were previously rated as substandard because of your weight or because you smoked, and you managed to quit or improve your health, you can sometimes reapply later.
And get a better classification.
And lower your rate.
Significantly.
Okay, let's get to the numbers because this is the most compelling part of the data. Let's stop talking about higher costs in the abstract and look at the actual math. What's the annual rate of increase we're seeing?
This is really where the penny drops for a lot of people. On average, just as a baseline, the premium goes up about 8% to 10% for every single year of age that you wait.
Wait, every year? So that's not a one-time thing. That's your permanent payment going up 10% because you waited 12 months.
That's your new higher base rate.
Yeah.
Forever. And it accelerates.
Right, because the risk profile changes so much in midlife.
Exactly. When you're in your 30s, the increase might be closer to 5% a year. But once you hit your 40s, that rate pushes up to maybe 5% to 8%.
That's over 50. If you're over 50, that annual jump gets into the 9% to 12% range. Per year, the curve just gets steeper and steeper.
Let's use that specific example from our research because this really brings it home. We're talking about a standard male buyer wants a new 20-year term policy, $1 million of coverage.
A very common scenario.
The data shows that if he buys this policy at age 45, his annual premium is $1,125. Can you walk us through what happens if he just procrastinates?
It is a harsh lesson. If that same person waits just 1 year and buys the exact same policy at age 46, the cost jumps to $1,225.
$100 penalty, just like that.
Forever. And if he waits until he's 47, the premium is up again to $1,345 a year.
Hold on. Let's pause there. That's a difference of $220 a year between age 45 and 47.
Yep.
Over a 20-year term policy, we're talking about What, $4,400 in extra premiums? Just for hesitating for 2 years. That's real money.
It is absolutely real money, and that assumes his health stays perfect during that 2-year delay.
Right. That calculation doesn't even factor in the risk of, developing high blood pressure or something in the meantime.
Which would push the rate up even further from that 1345 benchmark. The why is it's simple math. Every birthday puts you 1 year closer to the insurance carrier having to pay out. The cost has to reflect that.
And that example was for a term policy, which is probably the most common type. We should probably differentiate between term and permanent coverage because age hits their premium structure in different ways.
We should. Let's start with term life. The premium is determined the day you buy it, and it's fixed, or level, for the whole term.
10, 20, 30 years.
Right. And what the insurers are doing is basically averaging the mortality costs over that whole duration. You pay the same steady amount every year.
Which keeps payments predictable. That's why it's usually the cheapest option at the start.
It is, but
There's a huge financial cliff at the end of that term, isn't there? The fixed rate suddenly has to catch up to reality.
that's the critical warning. I mean, once that 20 or 30 years is up, the carrier has to reevaluate you at your new, much older age, say 65 or 75. And the new rates can be so high that many people just can't afford to renew.
They just let the coverage lapse.
They're forced to.
Okay, so what about permanent life, like whole or universal life? That has the cash value component, which complicates things.
It does. Permanent policies also start cheaper when you're young, but the rates are designed for lifetime coverage. Now, here's the key mechanism. The rates effectively increase over time because of rising mortality charges.
So the cost of the actual insurance part goes up as you get older.
Exactly. And that puts a bigger drain on the policy's tax-deferred cash value. If that cost starts eating up the cash value too quickly, the owner has to either put more money in, increase their premiums, or risk the whole policy lapsing.
So getting the best possible health rating when you're young is critical for a permanent policy.
It's everything. It keeps that mortality charge low and lets the cash value grow. A good rate of return on that cash value can also help, of course, keep premiums stable.
So we've established age raises the price a lot. But let's talk about the qualification hurdle. The sources show it's not just about cost. Advancing age affects if you can even buy certain policies.
Absolutely. Older ages they limit your options. For example, most carriers will only offer a 20-year term policy to someone who is, say, 18 to 70.
So if you wait until you're 71,
You might only get a 10-year term, or maybe no term coverage at all. The maximum issue age for term policies is often around 65 or 70.
and whole life.
More forgiving, they can sometimes be issued to people as old as 80 or 85, but as you can imagine, the premiums are astronomical.
And I'm guessing the older you are, the more hoops you have to jump through during that underwriting process, more
Yeah.
testing, more scrutiny.
Much more.
We found a really specific example in the data about those required tests. Can you talk about that threshold?
Yeah, this one is interesting. The threshold often hits right around age 45. So contrast this. A healthy 44-year-old applying for $500,000 of coverage might just need a basic exam, blood work, and a urine test.
Pretty standard stuff.
Very standard. But if that same person applies just 1 year later, at age 45, carriers frequently add a requirement. They might need a resting EKG on top of everything else.
EKG, just for crossing that one birthday.
Yep. It screens for underlying heart conditions that might not have symptoms yet. It's just the mid-40s is a statistical shift. Carriers start to see an uptick in cardiovascular issues, and the EKG is a cheap way for them to filter out that higher risk.
It's pure risk mitigation.
Pure risk mitigation.
And beyond the physical stuff, our research mentioned carriers are now looking at the mental condition of senior applicants. What are they testing for?
This is a newer development. For senior applicants, some carriers have started including cognitive evaluations or memory recall tests. They're looking for early signs of cognitive decline, Alzheimer's,
Things that present a huge long-term cost risk.
a huge risk. And we need to be clear on this. You can be declined outright for failing these cognitive tests, even if you're physically healthy.
Wow. That adds another whole layer of risk to waiting.
It does, though it's worth mentioning if you want to skip the exam process entirely,
Alternatives do exist.
yes, no exam policies are available, but there's a trade-off. The carrier's taking on a ton of unknown risk, so those policies are always going to cost you more than a fully underwritten plan.
You get for the convenience.
A lot, usually.
So, given all this, the annual price hikes, the stricter qualifications, the extra testing, the strategic advice from all our sources is pretty unanimous. Younger is better. So when is the optimal time to buy?
The best parallel is retirement savings. Delaying buying life insurance when you're young has a similar financial impact to delaying your retirement contributions. You miss out on the compounding benefits.
In this case, it's compounding cost savings.
Exactly, you're locking in a low rate. As for who needs it, the baseline is simple. You need life insurance if people depend on your income or if you have major debt that would be left behind.
A mortgage, credit card debt, private student loans.
All
And there's a really compelling argument for buying it early, even before you have a family. If you know you're going to have a mortgage or kids down the line, securing coverage now just locks in that affordable rate and saves you from those 8 to 12% annual hikes we talked about.
And for term life, the timing is pretty straightforward. You want the term to cover the period when your dependents need you most, until the kids are grown or the mortgage is paid.
But with permanent life, an early start is even more critical for that wealth building component.
It is, because the cash value grows tax deferred. Starting early gives it decades to accumulate real value. That money can then be used later for, a down payment on a house or to supplement your retirement income.
We also found one really fascinating strategy for locking in the absolute lowest rate possible, and that's insuring children.
It sounds a bit unusual, but if you're purely focused on cost, you can take out a permanent life policy on a child or even an infant. You're essentially locking in a near-zero mortality rate for their entire life.
And then you can transfer the policy to them when they turn 18.
That's right. It gives them cheap, permanent coverage for life, no matter what health issues they might develop later.
Okay, let's hammer this home one last time with the total cost figures from the research. This is the real difference between starting now versus 20 years from now.
Let's look at that same $500,000 20-year term policy for a healthy male. If he starts it at age 25, the total premium cost over the entire 20 years might be around $6,500.
Okay, and if he waits until 45?
If he waits until age 45, the total cost for the exact same coverage is over $14,600.
So that's more than an $8,000 penalty just for waiting.
The financial damage just compounds so quickly.
Which brings us to the two main risks of delaying. First, your premiums get way more expensive with every single birthday. And second, you risk developing health issues that could lead to even higher rates, or, worse, being declined for coverage altogether.
As underwriting gets more and more rigorous.
So the most actionable advice we found is incredibly simple. Try to buy before your next birthday. Get quotes from 2 or 3 different companies, and maybe talk to an independent agent who can shop around for you.
And the classic rule, don't buy more coverage than you actually need, but get what you need now.
Right.
And that really leads to the fundamental trade-off that everyone has to think about. Term policies are, significantly cheaper for solving immediate needs, but permanent policies have that tax-deferred cash growth over a lifetime. So the question you have to answer is, how do you balance the immediate need for a low premium versus maximizing those long-term compounding financial benefits that only an early start on a permanent policy can really provide? That's the strategic decision you have to make.